point, you knew I had to talk about Uber. I've got a pretty big history with Uber Boober, right? There's no doubt about it. Um, you know me and Uber. People don't like my opinion on Uber, right? Because this is a company not profitable by any means, and people don't like when I talk about that. So today we're going to look at this quarterly earnings report and see if I can maybe spit some positive news, right? We want to spit some positive news on Uber, right? Let's look at the good things. Stock down 4% after hours after earnings, so it was down a lot more. So there's a bit of an upswing. We'll take it. Up nearly 5% in the normal trading session, though, so that's really overall still a positive day for it. Can't be upset. GAAP EPS of negative $1.02. Missed by 14 cents. You're not going to hear me rave about that. There's no doubt. Revenue of $2.24 billion declined 30% year over year, but a beat by $60 million, which I just consider flat at that point. So here's where you think the bashing's coming in already. The high growth company that people are blasting their money into, posting a 30% decline in revenue. Now, I'm a realist, okay, and I understand the reasoning for it. Ride sharing is a garbage industry right now, and it's going to be probably for the rest of the year. So when you think about ride sharing, you think about the lack of social distance and the really a lot of safety precautions that come with it. There's a lot of people right now that, just due to everything going on, will not possibly go in another person's vehicle. They're not going to go in a stranger's vehicle. They don't want to. So that is going to hurt the company, because you see gross bookings of 10.6 or 10.2 billion versus 10.5 expected. I expected worse. Trips of 737 million versus 876 million trips expected. I have to be 100% honest with you. Those numbers shock me. I'm actually shocked that they were able to deliver that many trips. And I think that actually is a positive sign for the company. Because I assumed this stock was going to probably decline revenue by 50%. I'm being honest. I thought it was. I thought ride sharing was that dead in the water. But it is good for this company to see that it's not. And if you're investing in this company, maybe it's good to see that as well, you know. Monthly active platform customers of 55 million versus 82 expected. That's to be expected. So I really don't know where these consensus came up with. I don't know what analyst came up with this, because those are ridiculous expectations in the middle of a pandemic where everyone's focused about social distancing to all of a sudden assume that they're going to post that good of numbers. I don't know. Naturally, Lyft falls down because of it as well. Decline 67% in mobility, formerly known as rides, and 103% growth in delivery, Uber Eats. So there is benefit there. There's no doubt, and you see it from places like Blue Apron and the like, where a lot more people are ordering as opposed to going out in stores. So therefore, Uber Eats does benefit. Now, Uber Eats is not profitable by any means. It's the least profitable part of their business. So that adds to the lack of profitability for sure. Gross bookings we talked about. Mobility bookings were down 75%. So, yeah, I mean, what do you want me to say there? I thought it was going to decline 50%, and it declined 75%. So, in all honesty, very proud of them for having delivery take that much impact there. I mean, I'm pretty excited for them. If you think about it, I don't know what the heck they're trying to say it grew by. We'll look at the info to see, but you definitely, I mean, that's not expected, right? Ride sharing was down 75%. I thought it was going to be a more than 50% decline, and there it is. But it is good if you're in this stock to see that delivery carried that much to where you only saw a 30% decline in revenue. Definitely you can see growth. I mean, you can see positivity there. Adjusted loss of $837 million. Yikes, you know me. Yeah, don't get me started on that. Let's see the net loss, and then I'll really make my. You'll really hear the sigh come out. I'm just kidding. I was just kidding. Okay, we're zooming in just a little bit, getting nice and adjusted. Just one more zoom, please. Oh, the delay is incredible right now. Definitely a big delay. So, mobility revenue declined 67% year over year. Not unexpected, right? We knew this was going to be over 50%. At least I did. So I don't know what these analysts were talking about when they gave consensus numbers. These people are just dumb. I should not be smarter than most analysts out there. I shouldn't be, but I guess I am. Mobility adjusted EBITDA was $50 million in profit. What a shocker. That's what you like to see there. Delivery adjusted EBITDA was negative $232 million. So again, that is the least profitable part of their business. Even though they grew it, it's not profitable at all. The ride sharing is the profit part. And if that's the part of their industry, that's the part of their business that's going to be hurting for another full year, I don't like what that looks like. I don't know. I just don't know. I don't like what that looks like for the company, in my opinion. Even though they have the revenue boost, I just don't like the fact that that loss is just going to be continuing to just build up. Maybe that's just me, but the ride segment has been renamed to mobility, so good for them. I'm glad that they did that. Exited markets refer to markets that have been divested. So they have exited Austria, Czech Republic, Egypt, Honduras, India, which is kind of wild. India is a massive market potentially. Saudi Arabia, South Korea, Peru, Romania, United Arab Emirates, Ukraine, and Uruguay. See how I said that right? I said it right. I speak Spanish. Okay? Yo, hablo español. See that? What can I say? What else do you need me to say to prove to you? I'm too good at this. You see mobility shrank 90%, but from the delivery aspect, they did see a 19% growth in terms of loss. Decline in loss, I guess is a way to say it. That's probably the way to say it. Growth and loss. Loss and loss. Is that double negatives? Too many negatives make a positive, right? That's what they've always said. Gross bookings, again, 75% decline and 106% growth in delivery. And freight grew 27%. Freight's definitely a big portion of this business too, potentially, that a lot of people are really banking on for the future. And that's obviously a 3 months ending look at it. As far as that's concerned, good to see that. I really want to see overall. You can see by area here. Every single place saw a decline as far as revenue by region. Besides Asia Pacific holding it down, baby. Asia Pacific saw 30% growth, where everyone else was down 30% or more. Delivery, obviously, they talk about the good stuff there. Recent developments, the acquirement of Postmates, which is why they're changing the name to Delivery as opposed to just Uber Eats. They're approximately $2.65 billion in all-stock transaction to purchase this company. A lot of money for sure. And once that transaction goes through, you're going to see another disastrous quarter as far as profits concerned. You just anticipate it with Uber at this point. So we definitely expect it. They acquired Route Match, a leading provider of software service as a solution, or software as a service solutions to over 500 North American and Australian public transportation systems. Good for them. And they signed an agreement to acquire AutoCab, which is a UK technology company that provides taxi and private hire operators with booking and dispatch software and related technology. So what they're doing makes plenty of sense. We look at the balance sheet because we have to. Yield notes we're looking on the right, so cash and cash equivalents did shrink, definitely. Total current assets is at 9.6 billion versus 13.9 billion 6 months ago. I'm hoping the liabilities shrink as well, otherwise I won't be a happy boy. Total assets shrank from 31.7 to 28.2 now, so shrank around $3 billion there. Total liabilities, though, did rise from 16.5 billion now to 17.7, rose by around 1.2 billion. So you don't like to see that. Total stockholder equity fell quite a bit. Now it's at 10 billion versus 14.8 billion 6 months ago. And after the acquisition of Postmates, you're likely going to see an even worse balance sheet. So definitely something you need to consider there is a worsening balance sheet for this company, but all things considered, not the world's worst balance sheet, not the world's worst balance sheet by any means, but I need to see profitability, and my concern is with the ride-sharing segment, which is the only profitable segment, seeing that decline so much and it's going to be declined for a year. I don't like what this company has to offer me by any means. Trading in a market cap of $60 billion, when really annualized revenue this year likely is going to fall around the $10 billion, which, all things considered, 3 times the amount there, 6 times the amount isn't an incredible stretch, but it is when you talk about the incredible loss this company's facing as well in terms of just operating losses, just ugly for this company, and it's going to be for another full year, really. So take that as you will. Uber, not a company I'm considering buying by any means. So hope you enjoyed.